Investment advice by Lily Edwards and Bethany Parradine. The objective of this portfolio is to advise the client on where to invest their recently inherited £100,000 and will cover potential investment options, the risk and return of each, the tax implications, EMH, and an overall recommendation of an investment that gives a balance between liquidity and growth, risk and return. We will discuss stocks, corporate bonds, and a high interest savings account.
The first type of investment we chose to look at is stocks or equities. Investing in equity comes with the possibility to increase the value of the amount invested. The long-term average annual returns for equities in the UK is measured on the FTSE 100, and the average annual return is 6.3% from 2003 to 2023. It tracks the performance of the top 100 traded companies in the UK, such as AstraZeneca and Shell. The attractiveness of equities can be influenced by the EPS, or the earnings per share. The greater the value of the EPS, the more investors will pay to invest, as the company is likely to have higher profits relative to their share price, so they will receive a greater return on their investment.
Features of stocks are as follows. There is inflation risk, which is typically high as it's historically correlated with lower returns on equities. Liquidity of stocks is typically high as they are easily tradable on the stock market. Risks of stocks are systematic risk, which are factors that affect the overall performance of investments in the entire market and is largely due to macroeconomics, and unsystematic risk, which is a company specific risk, which is technological innovation and regulatory changes. To generate higher expected returns, investors usually need to take on more risks. A higher stock price means higher volatility and higher risk, vice versa for a lower stock price.
The second type of investment we chose to look at is corporate bonds. A bond is where a bondholder lends money to a company or government. The borrower makes regular interest payments until a set date in the future when they repay the initial loan amount. A bond has a YTM, yield to maturity, which is the total rate of the return earned when a bond makes all interest payments and repays the initial loan. The coupon rate is the annual interest rate established when the bond is issued that will not change throughout the lifespan of the bond. Current yield is the bond's coupon yield divided by its current market price. If the current market price changes, the current yield will change too. Bonds are generally considered lower risk than equities as it is a more secure investment, so is better for risk-averse investors as equities pose some risk due to them having no guaranteed return.
Features of corporate bonds are as follows. They are vulnerable to inflation risk as payouts are generally fixed on interest rates, so an increase in inflation diminishes their purchasing power. Bonds are considered less liquid than other assets as they must reach maturity before they can be redeemed. Risks include that when interest rates fall, bond prices rise, and when inflation increases, bonds can have a negative rate of return. Returns on corporate bonds are generally better than government bonds. They have a lower volatility and risk compared to equity.
The final type of investment we chose to cover is high interest savings accounts. After many years of low rates, savings have made a significant comeback over the last 18 months, and while rates are still on their way back down from recent peaks, top savings still pay more than inflation, so there's a chance to really make your money work for you. In March 2025, the best available interest rates are up to 5%. If you have £100,000 in savings, storing it in an account with that rate would leave you £5,000 better off after 1 year than store it in an account that doesn't pay interest. Investing £100,000 in a high interest savings account is a relatively low risk option, but it also comes with limited return potential compared to more volatile investments like stocks or bonds. The inflation risk of high interest savings accounts. So it is important to choose an account with a rate above the current CPI figure. If the interest rate on your account is below inflation, your savings will effectively lose value over time. High interest savings account offer a high degree of liquidity. With a high interest savings account, you can typically make withdrawals or transfers online through mobile apps or by visiting a branch if the bank has physical locations. High interest savings accounts have low risk, however, all investments involve risk. The value of your investment can go up as well as down, so you could get back less than what you invested. High interest savings accounts offer better returns than standard accounts. However, compared to more volatile investments such as stocks or bonds, there is limited return potential. High interest savings accounts are volatile as interest rates have been rising and falling depending on the type of savings account and the bank you are invested in.
The statistical methods of the investments discussed are standard deviation, which measures the volatility or risk of a stock's return. A volatile stock has a high deviation, while a stable stock usually has a low deviation. The beta measure are used by investors to gauge how much risk a stock adds to a portfolio. A beta of 1 for a stock means it has been volatile on the broader market. Below 1 implies less volatility.
Examples of each investment. So, if we were to invest the whole £100,000 into a high interest savings account, a 5% interest rate on this savings account would mean that you'd receive £5,000 of interest after 1 year. And after 5 years, if the interest rate stays at 5%, you will have £27,628 worth of interest on your savings. Investing £100,000 into equities. So, historically, the average annual return for the stock market, as represented by indexes like the S&P 500, has been around 7% to 10% per year after adjusting for inflation. This would result in returns between £7,000 and £10,000 on top of the £100,000 initial investment each year. Investing £100,000 into corporate bonds. Historically, the average annual return on a corporate bond is 5.71%. According to S&P Global, this would result in returns of around £5,710 from a £100,000 investment.
The efficient market hypothesis is a theory that suggests financial markets are efficient and incorporate all available information into asset prices. According to the EMH, it is impossible to consistently outperform the market by employing strategies such as technical analysis or fundamental analysis. In an efficient market, no single piece of information can give an investor an edge, making it virtually impossible for investors to consistently beat the market through stock selection or market timing.
The efficient market hypothesis impacts all our investments. When it comes to equity, the EMH has a significant impact on investing as it suggests the investors should not attempt to pick individual stocks or time the market. Instead, investors should focus on diversifying their portfolios and investing in low-cost index funds that track the overall market. Savings accounts. Efficient market hypothesis does not directly impact savings accounts in the same way it affects investments in the stock market or other securities. Its influence is felt in the way that savings account interest rates are set by banks. Corporate bonds. In an efficient market, it is difficult for investors to consistently outperform the market by picking individual bonds or trying to time interest rates movements. The most effective strategy for many investors might be to invest passively in a diversified corporate bond portfolio or bond index funds.
The tax implications of each investment are as follows. Taxes on equities will include income tax and capital gains tax when you sell shares that have increased in value. It is the increase in value of the equity that is taxed minus what you bought it for. Tax on dividends will also be incurred if the money being received from the dividends is over £500 per year. Taxes on bonds will include income tax and capital gains tax. Short-term capital gains are taxed as ordinary income, and long-term capital gains are taxed as capital gains rates. Qualified dividends are subject to 0, 15, or 20% capital gains tax. Taxation on high interest savings accounts may be subject to income tax, although this can often be offset with personal savings allowance.
So, we chose to look at two types of tax optimizing strategies that the investors could use. These are UK gilts and ISAs. UK gilts, government bonds, can be a part of a tax optimizing strategy when investing money, particularly if you're looking for a relatively low risk investment option that provides a predictable income stream. Gilts are typically not subject to capital gains tax because they are considered exempt from capital gains tax in the UK. If you sell gilts for a profit before maturity, you don't have to pay capital gains tax on the gains, which you would have to do with most other types of investments like stocks. ISAs, or individual savings accounts, are a popular and powerful tax optimizing strategy in the UK. They offer several key tax advantages and are an essential tool for many investors and savers looking to reduce their tax liabilities. ISAs and high interest savings accounts are closely associated in the sense that they are both ways to save and earn interest. A high interest savings account can be held within an ISA. When you open an ISA, you can choose to open a cash ISA, which is a savings account that allows you to earn interest tax free. However, the government has recently set an annual limit on how much you can contribute to ISAs. It is currently £20,000 per year.
To conclude, we have our advisory investment. We would advise to invest the £100,000 between equity, corporate bonds, and a cash ISA. Investing £50,000 into equities. Equities are a higher risk investment than bonds and a cash ISA, but have greater returns. An investment of £50,000 at 6.3% annual rate of return would see a return of £3,150 per year. Depending on the volatility of the equity you choose to invest in, the rate of return will vary. Typically, the higher the volatility, the higher the risk.
We would also advise that you invest £30,000 into corporate bonds. Bonds are a mid-range risk out of the three, and they are less liquid than the other two investments. An investment of £30,000 should provide a return of £1,527 at a 5.09% annual rate of return. The rate of return will vary depending on the type of corporate bond chosen.
Investing £20,000 into a cash ISA. Investing into a cash ISA is a low risk, high liquidity investment. Ensuring the interest rate is above inflation for your investment is vital to ensure the savings do not lose value over time. An investment of £20,000 will see a return of roughly £1,180 per year on an instant cash ISA from an interest rate of 5.9%.
The estimated total annual return for 1 year would be £5,857 on top of the £100,000 initial investment. Overall, the investments vary in risk, volatility, and return. Having the £100,000 distributed through different investments will reduce risk, maintain liquidity, as some investments are more liquid than others, and mean tax efficiency, as ISAs are tax free.
And lastly, we have the references used throughout this portfolio.